Yo, what's up, Eli? How you been? How you doing, my man? Nice. That's what's up. Working on your project. Okay. Cool. Music project? Or you mean like some school stuff? Oh, school. Okay. Cool. That's good. How's that coming out? Coming along. Good. Oh, you just finished. Okay. Marco me so I could see it. Or if it's not a physical thing, I don't know. You can maybe explain it. Yeah. I need to get a phone charger. It's on the computer. Okay. Cool, cool. Make sure my phone does not die. Okay, there we go. One thing about New York, your feet are gonna hurt. That's for sure. From all the walking around. And today my feet definitely hurt. At least me. I don't know if that goes for everybody, but at least me, it does. So at the starting of the week, rhythm starts and rhythm speak. It's only Monday. What time is it? Eli said he gonna get a car. Man, you ain't gonna find no parking if you get a car, bro. You are not gonna find any parking from place to place. There's no parking. You can't put the car any and everywhere. You know what I mean? You're gonna be stuck like Chuck in New York trying to drive around. You're gonna be late to everything because you can't find parking to put the car in. Look, it's gonna be the car almost is a negative in New York. Yes, bro. On like the weekends, if you want to get out the city, all the other stuff, yeah, you should get a car and you can maybe drive around and get out and go upstate and do all the other stuff. But if you're in the city and you're trying to go from here to here for real, you're not gonna be able to consistently put your car somewhere in New York. Unless now you got like a placement of like 4 or 5 garages to the same place that you usually go to, like roughly, like if you got a parking spot or you're by your crib, parking spot maybe in a garage somewhere near your work. I paid 150 for 3 days. Exactly, right? And you're gonna be paying a lot of money to have a car just to be in New York. So you're better off just paying the $3 and hopping on the subway more times than not. But yeah. So let's get a bit into markets. Let's talk about it. So I actually recently just dropped Instagram reel, just going over certain stuff right now. And I think let me see. So really right now, I think there's been a huge shift in markets as of late, where we see a lot of what was working for quite some time no longer working. And if we're being honest, like, and it's up to you to be aware and able and emotionally detached enough to try to navigate the new like realm of things, right? Because like, let me see if I could try and see the different regimes or the different like metas, right? Like basically it was, I mean, at least as of late, it's been, or maybe not late, but like 2022 into, let me just pull it up. I'm usually better with connecting history and the chart itself. So let's just do that real quick. Cool. So this is silver. Nice, whatever. Excuse me. But let's take a look at what we got going on in the full thing, right? So like if we go take a look at the, where's the Mag 7? If we look at it from a monthly basis, okay, that's Apple on a monthly basis, right? So from basically COVID, I would say from COVID, roughly 2020, 2021, right? Where money became, infinite, where we started printing tons and tons and tons of money. A lot of these assets, a lot of these companies just went up. Meta, just, like you couldn't really try to like, you couldn't do no wrong owning these names, basically is what I'm trying to say. You can do no wrong, right? And really only more recently, NVIDIA, and I say recent, like with quotes, I guess, right? Because ChatGPT dropped end of 2022 and into 2023. Like that's the exact bottom. You know what I mean? And it's been straight boom up since, from 300 billion to 4.2 trillion, 4.5 trillion on market caps, right? So like in 36 months, basically, the company added 4.2 trillion onto their market cap. Well, now it's a little bit lower. So in 36 months, maybe 40 now at this point, it's added 3.9 trillion. And the idea, right? And it's not just them, but it's also some of these other names, right? Semiconductor names, all this jazz, right? Where we saw great upside in tons of these names, ASML as well included, Tower Semi, TSMI. Wait, what? Taiwan Semiconductor, TSM. My fault. TSM. All those names, right? They've been beneficiaries of the AI, right? Because that was what the meta was. That was what everybody wanted to own, every sector, right? Why? Because there's the belief that this thing is super important and it's going to create new capital. It's going to create more productivity for these companies. Sorry, not really no more productivity, but more sales for these companies, because there's going to be more things that are coming out, more implementations, more users, more money that they can create as revenue, right? And late last year, we saw a question mark on that, right? We saw Michael Burry come out and say like, oh, it's a bubble, like, you know what I mean? We're about to like burst. They're talking about how they're depreciating their assets at over a 5-year span, but it really needs to be over a X period of span, like, you know what I mean? Like X period instead of what is it? Like, and it will, that's basically what it was. So they were, in a way, at least some people were saying, Michael Burry included, that like, yo, they were overhyping it, and their earnings look good because of how they're depreciating certain things, right? That was that whole thing that we got like September, October of last year, right? And then the bubble, that talk continued to talk, right? Like it was like a real big thing. And because of that, the indexes fell, included, and the very concentrated AI names also fell alongside it, right? And this is kind of why it's super important to know what moves these things, right? What moves these assets? And it goes back to my conversation that I'm pretty sure I've had with you all before, of like perception versus reality, right? Some of these companies come out and say these things or have these announcements and XYZ, ABC, right? It shifts the perspective on something, right? Oh, AI is a big deal, right? Like, or whatever, X, insert X anything. It's a big deal. The perception has shifted, meaning, oh, this stock is probably more valuable today than it is, or than it was last week, right? But we don't know that for sure. A lot of these names move off of announcements. They move off of, oh, we're going to incorporate this and do that and do that, right? And a big example of that is Oracle. Oracle's a huge example of that. Actually, I'd say it's probably the best example of that, right? And I'm going to break it down right now. Ready? Oracle. We know it's a database company, package software company. They own tons and tons and tons of like cloud space. They do corporate cloud licensing and hardware services, XYZ, ABC, right? That's why they also got the TikTok deal, right? Where they're hosting the TikTok data on their servers so that it could be onshore in the US and out of the whole question of China and national defense and national sovereignty, and making sure that the data stays onshore, XYZ, right? So Oracle has been that for many, many, many years. Larry Ellison has built that to be like super hardware systems, servers, right? Understanding what these companies do is important, is vital to being in the markets on a day-to-day basis. Because that's how you can apply what these news things are coming out about and how it can trickle into the perception of the asset in question, in this case, Oracle, right? And early 2025, OpenAI could do no wrong. OpenAI was the greatest thing since sliced bread, right? It was massive amount of users, and they're talking about AI productivity now. They're talking about this. You got companies like NVIDIA doing this deal with them. You got companies like any and every company signed a deal with AI. We know that. I mean, OpenAI and ChatGPT, right? Because they were number one. They were the first to market, really. And they were number one. They had the best chatbot, basically, at that time. And there wasn't really any competition there, right? Because Gemini didn't quite get its footing, which is Google's product. Claude was there, but I don't think many people knew of it, right? Like, it wasn't like in the forefront. The other options were DeepSeek, which many people don't want to really give their data to Chinese firms, is which kind of what I believe. Like early 2025, DeepSeek kind of shook up the game because they talked about how they did all this with little capital, and so like the question mark was, oh, is OpenAI even valuable then? Is it as valuable? Like, do we actually need this much compute and this much funding to go to AI if DeepSeek just did it with such little funding, right? Like, and that's how another way of perception shift. Remember that perception shift as well at the beginning of the year? I think January, February, around this time, DeepSeek came out, because actually it was after Davos last year that I think DeepSeek, the Chinese AI model, came out, and everything came into question. Oh, we don't need to spend this much on AI because look what DeepSeek did, right? That's a perception shift. We need to spend money. AI is important. It is the most groundbreaking thing. DeepSeek comes along and shifts the perspective. Not necessarily for long. It didn't shift it for long. It shifted it for about a month to 2.5 months to say, oh, snap, maybe we don't need to spend that much, right? And that's where you can find trades. You can find trades on the perspective shifts, right? So let's continue to dive deeper, more particularly in this Oracle scenario, right? Oracle does this cloud stuff. We just talked about it. They signed a deal with OpenAI. They're going to do all these commitments. They're going to help OpenAI with their cloud compute, all the space that they need, right? What happens? The company got re-rated. We're talking like $155 into $300. It jumped 100% in a matter of what, 4 months? Right? So what we're saying is this $400 billion market cap, $420 billion, which is basically what it was, jumped nearly into $900 billion in 4 months, right? That was a perception shift. Why? Because Oracle was perceived to be the latter, outdated computer server hardware company, and then maybe powering legacy tech, like older software, older internet products, stuff like that, to now being in bed with the greatest thing since sliced bread, OpenAI. So what happened? Their company got re-rated, basically the entire market cap of OpenAI, right? So we saw this huge push, 115 to 300 plus off that deal news. And then what happened? The OpenAI bubble talks came out, right? And do I think it's a bubble? No, not quite, but the rest of the market does. So guess what? The perception shifted. From it being the greatest thing, it's now cancerous. OpenAI is cancerous because they continue to burn money month over month over month, with revenues, right? They have revenue. They're making some money, but are they profitable? No. And they're going out asking for more money, panhandling the rest of the world for it, right? Saying, "Oh, we'll get there. We'll get AGI. We just need another 50 billion. We just need another 200 billion. We need more money to get it done." And right? And that whole time you have products from Claude coming out doing vibe coding this and co-work that, and then they just launched just a few days yesterday or the day before a legal product and that, and then you also got Gemini creeping in and taking market share too. We see it all in the data. Right? So now what once was super sexy to be in bed with OpenAI is no longer that. As you can see here in the price, it got re-rated again back to where it was pre-OpenAI deal, right? So this is a perfect example of where understanding the potential outcome of a perception shift allows you to be in a trade. You get me? If you get me, give me a thumbs up in the chat. If you get me, give me thumbs up in the chat. I want to see the thumbs up come through. I don't even know how to put an emoji in here, but one sec. Okay, let's see. No, nobody gets me? Dang, that's crazy. Oh, okay, got it. Right? So this is where the opportunity, thanks Eli, cool. So this is where you can see the opportunities come out, right? It does require you to be, a little bit in the weeds or in the depth on like what's actually happening on a day-to-day basis, because these news reports come out and it's super important to do these things, or just be aware of what even all in all is coming together. But that's what happens when these companies get re-rated. And this is where opportunities sit there and lie, right? So what our job is as market participants in the stock market, our job is to find those things that are worthy of the perception shift, right? Is this news actually momentum moving? Or is it just something that will be overlooked by the rest of society, right? And the best way to gauge that is to continue to collect your sample size of what happens when things happen. And this is what I'll say. Ready? Got it. When you collect your sample size of what happens when things happen, right? So let's say this. Bet. We here. Cool. Let's start with this. Appreciate it. In 2020, we had in 2021 as well, right? The question or the major thing during that moment was COVID, right? Basically, or like the tail end of COVID-ish, right? Like us trying to thrust our way out of COVID. Like, got it. And the perception was going into COVID, right? That the world is going to end, basically. Like, where the companies that said they were going to make money are no longer going to be able to make money. So their perception shifted. And every single thing hit the floor, right? Because what was once not important, what was, things like travel, right? If we just go look at American Airlines, AAL is a ticker? Okay, cool. We just go look at the ticker, American Airlines, right? All right. See you, Eli. maybe American Airlines is not even a good example because this company is just in the gutter, right? Um, but yeah, so maybe Delta be better. Yeah, Delta is more visually like in along this, right? Right, people were flying before COVID. Yeah, it's fine. Delta, like one of the most profitable airlines ever. Rah, rah, rah. It's awesome. It's great. They beat earnings. They give back major bonuses. Crazy stuff was going on. Then COVID came and it dropped 50+%, along with many other names. Why? Because the perception was nobody's going to fly. Who's going to make any money? Sick. Delta. Yeah. Love Delta, honestly, personally. Right? No. So the perception shifted from, yeah, people are going to fly, people are going to travel, we'll see some growth, to nothing. That Euro summer did not exist. Why? Because COVID was here. Nobody was trying to go out there to go get COVID. Nobody knew what COVID was going to do. Next thing you know, we got people bleeding from their eyeballs. Maybe not actually, but I'm just saying, right? The perception shifted. And then what happened? Over time, the perception got a bit better. It shifted, right? And then same thing here. If we look at Zoom, something that was not important before, right? Like, okay, yeah, you sometimes you take a few calls and some of those calls are for business. You do it on a voice. Okay, fine, right? But it turned into a term. It turned into, I'm gonna go call an Uber. I'm gonna Zoom. Oh, you Zoom me? Yeah, okay. So the perception shifted. This company became enormously valuable. Why? Because everybody was using it on top of the perception of, hey, we can't go anywhere. So this thing has to be valuable until COVID came, and then it went. And then where did it go? It re-rated all the way back. The perception shifted. We don't need Zoom. As the perception shifted from, oh my God, Zoom is kind of cool. Yeah, it's cool. Oh, we got everybody. Oh, Zoom meet, Zoom. Everybody's working from home. Everybody got to get a phone call. Everybody got to hop on one of these video meets. To, oh, COVID's going away a bit. It's not really that. Yeah, we come in. Oh yeah, you can come in the office 2 days out of the week. You can still stay remote. And then we don't. Oh, they're mandating you back in office. You have to go in office now. You got Jamie Dimon talking about, no, we don't want anybody in office. If you're young and serious about your career, if you're young and serious about your career, you have to come in office and this, that, and the other. No, not quite cybersecurity risk, but that's a part of it, right? So maybe out of this like 85% move lower, maybe 10% of it was cybersecurity risk. But the overarching, looking at it from a big point of view, was people are going back in the office. We don't need to Zoom 10 times a week. We now Zoom maybe twice a week. And it's really only to external companies, not internally, right? So the usage, the daily active users just fell through the roof because companies were forcing people back into the office. It's a perception change. A perception change that was actually amplified by a follow-through of reality. And that's why you see such major re-ratings. Same thing with the Oracle scenario. They signed a deal with OpenAI. We're gonna do this XYZ rada BBB, right? Oh, that's awesome. OpenAI is the greatest until OpenAI comes back and they're like, yeah, we're making money, but we need to make more. We need to get more funding to actually be able to push this through. Right? And the perception shifted before our eyes that maybe that OpenAI deal ain't that fire. Not only that, but on top of that, the reality was Oracle actually used a lot of debt to fund that deal. And that's also amplifying this downside that we're seeing now. Right? So you're seeing tons of flow into their credit default swaps. Like, oh, are they really going to be able to afford it? Can they afford it? Right? 100 billion in capex. Like can you know what I mean? The perception shifting. Whether it becomes a full-on reality and they potentially default soon is another question. But the perception is this company is not as valuable as it was when they originally signed that deal. Why? Maybe because OpenAI has fallen out of favor from the public markets, and everybody's looking at Claude now, right? And the same thing we can see as of recent with the software stocks. Workday, like what's in this, right? So this is a software ETF. It's down dramatically. Where are we at? It's down 21% year to date. We're only like 35 days into the year or something like that. 20, bro, what? That's a huge re-rating, right? So you go look at Workday. It's down, and it's down bad. Look at ServiceNow, down, and down bad. We look at LegalZoom, LZ, it's down. And it's continued to go down. It's actually been pretty down since day one. So shoot, maybe it's not that much lower it could go, but down, right? Salesforce, exactly. All those names, CRM, are taking a poop and they're down massive. Why? Because of this. Because of Claude Code. Because of Claude Cowork. Right? Because the perception has shifted from, oh, those companies are going to probably integrate heavily with these, softwares and their offerings and all this other stuff. And to now, well, hey, maybe we don't need to do ServiceNow and software, right? Maybe we just need to hire 2 people internally to build out micro apps for our team so that we can process things faster and go through it, right? Like maybe we don't need and somebody in my community recently said this. He's an engineer. He said, I'm trying to find it. He said, the need for humans clicking on screens is becoming more and more useless with the rise of AI. And when he said that, I was like, wow, that's really well said, because like effectively what these softwares are doing are offering a platform to do the clicking, and then the individuals do the manual work and the actual like compute behind, or maybe not really the compute, but like the full thought process of it, right? But now the first 20% of your work, the first 30%, and now in some cases with co-work and other bigger projects like this, the perception has shifted. Because before it was, oh, AI is just a chat bot. You could ask it for help. It's sometimes stupid. I don't know. Da, 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 da. Maybe it could give you a cool framework to go off of, right? The perception was, oh, AI can only do like the first 10% of your work. How much productivity are you even going to get from it, right? To now, it doing full, almost end-to-end products. It like almost like, so if you're actually technologically savvy enough to run these AIs and connect APIs and MCPs and do all that work, like you can basically automate so much of your grunt work. Like I'm talking about before, in our chatbot phase of 2022 and 2023 into 2024, even last year, what the AI developments have shown is that well, I can do all these connections and and bring in my own data from my own dashboards and be able to automatically make calendar invites, work across the webs, do all these things, aggregate, build spreadsheets for me, prepare reports, analyze my notes, right? Like take them, summarize it, and push it back. Like if I were to put a percent on this, what was the perception of, oh, it's just a chat bot, it gives you a cool framework, 10 to 15% of your work is maybe like slightly beneficial, like, you know, get a cool little benefit, cool little kick, into now, I think in a major way, it probably puts you at 50%, right? Like it can, in that, again, if you're knowledgeable about how to use these products, you could probably cut a good fat of chunk off of your everyday mundane tasks by using these systems properly and efficiently, right? Yeah, it is pretty scary what it's doing for software engineering, right? And it's causing us to retool, right? Everybody's like, oh, what is it going to do for jobs? What is it going to do for this and this? It's creating a revolution in jobs, right? Because all through maybe the last 10, 15 years, right? From the internet era of 2002, roughly, right? Like late 90s and 2004 into now, it was learn how to code because we're going to need more coders to be able to run hardware, right? And now it's a little bit of, you know, learn how to prompt so that you can become a more efficient coder, right? So maybe you can do the more, you know, the more like zoomed out high level thinking of what application you're building and how you want it to connect to other things down the pipeline, and then not so much the everyday, oh, please fix, I'm typing this out to do that, right? So that's a perception shift. The same way how, right? The same way how, again, in the 90s, something that was so important, everybody thought the yellow pages were so important. It's like, it's the best place to do your marketing for your business and XYZ, ABC, all until Google came along and the internet came along. And now each company can have their own website. Now each company, as long as you Google the company's name, you can find all the locations, what's their operation hours, what's their email, what's their phone number, right? The perception occurred, and then the follow through of the actuality came with it, right? So we're seeing right now the perception shift of software. Like, oh, do we need CRM anymore? Like, do we need Salesforce as much as we did last year, or even maybe 2002? Maybe not. Maybe some of these smaller companies that are that maybe, you know, want to have these more robust and compliant softwares, maybe they can hire 2 people and they can build out their own custom shit. So the perception again has shifted. We don't need these big SaaS companies at 200 billion market cap, right? Exactly. How can you better write prompts? How can you, you know, keep it? How can you keep the AI within context so it doesn't go on and on and on about a bunch of other stuff that doesn't really matter, and it's building out all this extra stuff, and it's like, okay, hold on, relax, reel it in. I need you to focus on this to fix this issue I'm having, right? And that's really where we're seeing now, whether it's going to be an actuality, right? Are they going to actually see this show up and affect that company's bottom line is what's next in question. And that's where we should be focusing. Is Salesforce, is ServiceNow, are these software companies going to come out and give these headlines and say, well, you know, we're not signing as many companies as we were last quarter. We're not, you know what I mean? We're seeing the retention of our current clients decline. right? We're seeing, right? This is where you have to start looking for those cracks in the surface to confirm the continuation, to confirm the perception shift into the reality. Otherwise, it will reverse. Because right now, this is all froth. This 20% re-rating right now is perception that Claude and these other platforms and AIs are going to take over and be able to steal customers from these individuals. Right? And now whether that's a reality is what's going to be the next question. Because if any moment in time something contrary to that current narrative of the perception shift comes out and the market believes it and it comes with actual like depth to it and some magnitude within it, you best believe these companies will re-rate again. They will re-rate again and we will see it go back up. And that's where you can find your trade opportunities. That's where you can find your investment opportunities as well. Right? Maybe something comes about and CRM is actually saying like, oh, more and more people are actually more interested in our software now. Why? Oh, because we've directly integrated with Claude or Gemini or some of these other companies. Right? So not only are we benefiting off of our current customer base of individuals who are already members and recurring monthly users of the software, but now we actually have a full consulting arm to help these companies integrate AI into their systems that they currently exist within the CRM platform, within the Salesforce, within the ServiceNow, within insert software company here. And that can be something that may be large enough to shift the perception. Maybe. Just last week, we saw Microsoft come out with earnings, and the earnings itself were pretty good. Like they beat. They made money, right? But the main thing the market focused on, and the stock cratered. I think it fell like 10%. Look, there it is right there. Boom. Yeah, it fell like 10% plus off of this one thing. And I'm gonna pull it up. I'm gonna pull it up. Off this one data point that everybody was concerned about. I'm gonna try and find it. I can't find it. Oh my god. Okay, let me see if I can just scroll. I can see the chart. Sorry, guys. I put way too much. Boom. Here it is. Okay, so I can share it now. Right? They focus on this one data point. Microsoft CEO showed that 40. This is what they showed: performance obligations. Right? And that's the other thing too. It gets hard to find these things or find these perception shifts and find these reality shifts when they hide them within these like words that are a bit confusing, right? To the naked eye. This is where it's important for you to Google things, AI it, understand what commercial remaining performance obligations means so that you can understand what this graph is actually trying to show us. Because otherwise, it just looks like it's up and to the right and it looks good, growth, right? But what remaining performance obligations means in like the nuts and bolts, it basically means the amount of compute or cloud offerings that they have to offer without receiving new compensation, without receiving new money. So basically, what they're saying is that 45% of our commercial RPO balance is from OpenAI. It significantly grew from 28%, or significantly grew 28% year over year, reflects an ongoing broad customer demand across the portfolio. Right. Meaning that they need to continually use more Microsoft Cloud and more compute there, and it's not really paying. The critical detail is that nearly half of this 625 billion backlog, a 625 billion backlog, 280 billion of it comes from Microsoft's agreement with OpenAI. It clearly, this likely reflects the compute Azure capacity commitments of OpenAI as its contracted AI infrastructure. Microsoft continuously gives OpenAI opportunity to compute on its Azure platform without receiving direct compensation for it. Simple. Stock go down. Why? Because OpenAI is the biggest thing, the most focused thing on right now in the world, basically. Like, okay, maybe not in the world. There's some other things that are also really important. But like in terms of market stuff, OpenAI's top 5, easy. Top 3, probably. And because of that, any cracks in that can do what we just have been griping about the past 47 minutes on the stream. The perception shift into potential reality. Sam Altman came on one of the streams, or one of the live streams with Brad Gerstner, I think, and was talking about money and how can they do this and X, Y, Z, and are you actually going to make money? Like, what's happening? Are you burning money? Right? Boom. And it clearly shows. Microsoft is footing the bill right now. Microsoft is footing the bill for OpenAI. Right? And that one thing overshadowed all of Microsoft's focus. Why? Because that shifted the perspective on OpenAI. I didn't even really come on here to talk about OpenAI for real and other stuff, but I just wanted to bring home a thought process of that. So yeah. Let's take a look at like what's going on across the markets, right? It looks like we have a shift in like what's actually going on, like across the board, right? And this is where I think is really important, because this is actually about what I was saying on my reel today that I posted on Instagram, right? It's so super important to understand that like what maybe worked a little bit ago may not continue to work because the regime changed. Before it was AI. And as Seth told us here, right? Like we, or Seth, I'm dead. That's hilarious. Tone, as what Antonio told us here. Hey, I wonder what that's going to do for the power infrastructure. What do we see? We see energy making new highs that we haven't seen ever, after being basically in a range up, down, all 2022 into now, basically. Right? So we need more power to do things. We need more of it. So although we may trade maybe 5 or 6 names, whoever you are or however you plan on producing capital for yourselves in this market by placing capital in an asset, right? It's also very important to make sure you continually zoom out. Look at things from a sector point of view. Okay, like energy, what's energy doing so far on the month or on the year? Energy's up 18% on the year. Okay, how's financials doing? Okay, they're roughly flat. They're like slightly lower. Okay, not too bad, but they've had a run. not like energy has. Energy has not had a full-on run as of recent. Like if we're being honest, this is a recent thing. This last 2 month move is fairly recent ish. Financials have been on a monster run, so this 1.5% some digestion. Oh, the technology sector, as of recent, it's been struggling a bit, and we can see it. Healthcare, what's happening there? Okay, slight up move to not too bad. Okay, utilities, utilities have done pretty well over the long run. Kind of like just now they're maybe slightly underperforming. I wonder what's going to happen there. Consumer discretionaries, wow. Right, discretionary spending has been pretty good over the last 5 years, 3 years. As of late, it's been pretty flat. I wonder what's happening there. Consumer staples, though, yo, that bad boy is booming. Okay, staples have been important. Why? Now I need to dive into that. Now I need to figure out what's happening in staples. Right? Industrial sector. Oh, don't even get me started on this. This thing's done amazing over time, and it seems like it's not stopping down. It's not stopping. Why? Because of all the different sectors that are coming together to move industrials. Right? We got a presidential administration focused on rare earths, focused on AI, focused on onshoring industry work, right? Bringing back blue collar, right? So they're focused on. So they're putting things into play that will be beneficial to these individuals in this sector. Caterpillar, Simons, these large industry players, communication sector. I mean, the communication sector is done pretty well. I wonder what's in it, though, right? That's another thing that will always take a minute to look in it. I think probably Meta may be in this communication sector just because it's social media and stuff, right? Then we got the real estate sector. Real estate's been pretty flat for quite some time, but it is slightly green. So maybe something's heating up here, right? It's something to be looking at, to then ask yourself what the heck is materials. Materials goes hand in hand with industrials. Oh, I wonder why they're both green. Because they go hand in hand. You need materials for the Caterpillar machine to move the copper wiring. Oh, why do we need copper wiring? Oh, we're building out AI data centers. Why are we building out AI data centers? Oh, because we have Claude and everybody's crazing out over the Gemini and ChatGPT, and we need more compute and rah B. You get me? So try to take a moment to connect these dots. Retail. Oh, wow. Retail's done pretty good as of late. Solidly good. Not bonkers, but solidly good. Right? And you can marry that same data with watching options flow, watching open interest shift. Oh, they're stacking in more buys. Oh, institutions are actually coming in. Oh, retail is coming along with institutions. That's going to be a big push, a nice drift into the upper end, right? Another thing I want to mention, right? Understand the asset that you are trading. You trade QQQ. If you trade QQQ, you have to understand that you're trading basically the Mag 7. Right? And let's talk about that real quick. Let's talk about that real quick. Boom. When you trade QQQ, you need to take the few minutes to go look up what the heck is actually in it. Oh, look, top ETF holdings right here. There's a total of about 101 of them. Okay. You telling me NVIDIA is worth 9% of the QQQ? Apple 8, Microsoft 7, Amazon basically 5, Tesla 4, Meta, Alphabet, and Broadcom, and then Palantir is 2% of QQQ. Oh, wow. So you're telling me these, what is this, 10 names? 3, 4. These 10 names account for, what is that, almost half? Nine plus 8 plus 7 plus 5 plus, let's just say 6, and another 7 plus another 2. Bro, these 10 companies make up 44% of the entire index. So guess what? So if I go look at the Mag 7 or these names in a vacuum, where's my Mag list here? There we go. If I look at these names in a vacuum and I see them performing poorly, guess what? QQQ has high odds that it is also going to perform poorly. Like, let's just be real about it. Math is math, right? And it's important to know what these underlying assets actually are made up of in that case. And you can see it too, because look, if we go and do something similar with the S&P 500, right? SPY, what's in SPY? Or State Street, right? Let's see what they got to say. I'm not going to take your cookies, whatever. Leave me alone. Ugh. SPY. Excuse me. Oh, guess what? The same damn thing. NVIDIA, Apple, Microsoft, Amazon, Alphabet, Broadcom, Meta, Tesla, Berkshire, excuse me. Right? Like, this is literally it. And in a way, it's a little bit less concentrated than what we just counted up in triple Qs, like 40% of these top 10, but like 7.4, 6.7, 5, 4, 3, 2 plus 3 plus 2 plus 2 plus 1. That's 36%. So basically a third of the S&P is made up of these names. And yet again, if these 10 names are not doing well, neither will the index. Done and dusted. Simple. Simple, right? And then you can see other things, right? You can find other products in all their glory to try and help you get an understanding of a more like in-depth picture. Why? Because the Invesco S&P 500 equal weighted index is actually up. It's up on the year. This is the S&P 500 equal weighted, basically meaning that NVIDIA doesn't account for 7% like it does in SPY. But in RSP, it probably accounts for all of 0.5% or maybe a quarter. And each individual name accounts for that. So when you really want to see growth, how are we actually growing, right? You can see the breadth of the entirety of the market, the entirety of the S&P 500, not just the S&P 10, okay? You can use products like RSP, tickers like this, to get a gauge on like what the heck's actually going on. The equal weighted index is up on the year, while the mega cap weighted index is down on the year, because the top 10 names ain't doing too hot. But the rest of the market is. Cyclical names are doing pretty darn well. Let's look at Caterpillar. And when I say cyclical, I mean names that do well when the economy is growing. Look at Caterpillar. It's up 20% year to date. Is it always? No. Industrial name, right? Let's look at Chevron. Look at them year to date, another 20%, right? Because equal weighted, right? Let's go look at Who are some other? Actually, let's go to that list. Let's find that list. B-spec, no. This is my China list. This is my health list. Come on, bro. Deep value. Look at it. Look at the deep value names. Costco. All green on the day. Right? Costco up 13% to this year. The Schwab US dividend name, which is basically an index of like all these other names, right? Up 12% on the year. Union Pacific. Who the heck cares about railroads? I do. They're up 8% on the year, and they offer a 2.2% dividend yield. Walmart, monstrous company, now just 14% on the year, and finally broke into the 1 trillion market cap as of recent. Big kudos to Walmart. Shout out to Walmart. I've been a shareholder since like 65. Amen. And then Hartford insurance companies up 2%, solid growth with a good dividend yield. CSX Corporation, railroads, right? Up 10% on the year. Dollar General, a name that's been in the trash for quite some time, is up 12% on the year. It's doing pretty well, right? Philip Morris, dividend name. Like these are names that aren't sexy. These are deep value cash creation machines at a very slow pace. They're not growth machines, but they're cash dispensing machines, right? Tobacco, whatever, right? These names are giving look at this. I think McDonald's took an all-time high today or something, or like yesterday, up 6% on the year. Coke, another monster, 10%. Waste Management, another monster, about 4% on the year with a 1.5% dividend yield at a 91 billion market cap. Verizon, this is one of my bad boys. This is one of my favorite dividend names of all time. I probably own more shares of Verizon, or like that's probably my largest position on accident. Like I just kept on buying Verizon and just buying it on recurring, and it was great that way. I'm up 15% year to date on the name that usually doesn't go up dramatically. It usually just spits out a cash in a dividend yield, like a 6% dividend yield. Like the goal is to have it pay for all my bills. It's going to definitely pay for my phone bill, and I have Verizon. So I'm basically just throwing my money in a full-on loop. I get my dividend, cool. I pay my phone bill. Get my dividend, cool. Pay my phone bill. I get a paycheck, cool. Buy more Verizon. Buy more Verizon, get a bigger dividend. Get a bigger dividend, pay my phone bill. Like it's like ideally the perfect loop. It's the loop that's the most hands off of your capital. Yeah, it's crazy sometimes. Oil tankers, yeah, not exactly right now, at least. I mean, I tend to look at the indexes to give me a point of view as to where money is going as a whole. So the indexes like OIH, like maybe there's something there. Like, right, if we look at this thing has been in the bottom. Like 2014, this thing was a different monster, trading at $1,000, right? And it's at 360 right now. There's tons of opportunities right here as well. Like oil tankers could be a play for sure. If you like a specific company in a specific region, that could be something for you for sure. But when you look at it, right? And then when I look at those indexes or those sectors, I say, okay, what's going on over there? And then you also look at leverage too. You can use these leverage indexes to also see what's happening in the micro subsectors of tech. So the semiconductor index is up a lot over the year, over the day. Like, look at that. Insane. But today, it didn't do too great. Why? Because it's triple leveraged. So it's 3x of what the sector did as a whole. You know what I mean? Nail, home builders and supplies of home builders. So materials as well as companies like Lennar and such. They did pretty good today. And they have done pretty good as of recent as well. Like there's tons of money pushing into that. Right? Like, what is this telling me? What is this telling me? The money is moving. The money is moving. So if I were to also go and take a look and corroborate what I'm seeing with these price increases with the options flow on top of that, USO, we're getting some active lines. And what? USO? Oh, US oil? Great. That's confirming what I'm seeing in the index. And then now I can pick which oil company do I want to really put energy into. Right? As you can see down here at the bottom, just to the left of me, you see UPS, people buying 2028 calls, right? Oh, interesting. They're putting 1.5 million where their mouth is. Let me scroll up. I can't really see that. Right? Some of these data points are maybe a bit hard to read. XOM, December of 2027 calls, 110. Willing to put 3.16 million on it. Let's be real here, guys. UPS, September, 110, willing to put 347K on it, right? The Dow, 35. The Dow and then 800K on it. They want to put 500,000 on it for April, June, right? Is that way? Hold on, let me check something. Is Dow like the Dow index or is it something else, right? That's what needs to be happening. When you guys see these things and you're asking questions of like, oh, what is that? Like, don't just go assume what it is. Go do the research to go spend time on these websites and figure out what that means and like, why does it matter? Oh, Dow? Oh, guess what? It's a chemical specialty company, right? Like use that time to look at it and try and gain an understanding. Dow is a materials science company which engages in development of innovative solutions. It operates through the following segments: packaging and specialty of plastics, industrial intermediaries and infrastructure, and performance materials and coatings and hydrocarbons and plastics and right? Oh, wait, guess what? Guess what? We saw, what did we see when we looked at the sectors? Let's go back to the sectors. We saw the materials sector have a materially upward day, not only an upward day, but an upward year, upward 2 years, upward 3, upward 5 years on a breakout of it being sitting sideways since basically 2021. Like, let's focus on the reality of what's actually happening. If it is not working, if tech is looking at you in the face and you're like, oh, why is Tesla down only 3% today? Why is NVIDIA still not at 200 or back above at 5 trillion? Stop spending so much time worrying about the wounds and go find the next alpha, because the market is always rotating. And it may not be directly in front of your face in these sexy names that are in AI all the time. Google reported earnings and that thing fell like a rock as if it doesn't print cash like nothing. Right? Because the perception is shifted. You got an administration willing to do anything about oil, willing to take over Caracas to make sure that there's oil, willing to make sure that these companies have enough power, right? You're seeing all these documents everywhere in relation to what's happening with the comparison of China's electricity levels in production in gigawatts and US production levels in gigawatts, right? You can see where these people are focused on. Why is Elon tweeting about the discrepancy in power levels between China and the US? Because it's important, at least to him. And maybe you don't like Elon. Okay, fine. But Elon's worth $850 billion. So best believe he's going to move the market in some way, shape, or form, whether that's through his direct investments, whether that's through his perception of those assets and those investments and how he displays that to society, or by simply just sharing information in a manner that changes the actuality of things, right? So again, leave your emotions at the door in the markets, right? I don't like such, I don't like this, I don't like... Fine. If you want to play the hardest game in the world on hard, super hard Hall of Fame mode, enjoy. Have fun burning capital day over day over. Not saying it's impossible, because it definitely is possible, right? But understand that this game is already as hard as ever. Why are you trying to swim upstream against the current when the answer is right in front of your face? So when you see these companies report earnings or any type of news event, something that actually pushes things, take a moment to read through it. Why did it do that? I don't get it. Doesn't make sense. You'll continue to compound and amass information and insights on how it moved the market today, so that when something similar happens later, you can understand how to position yourself to profit off of it. Right? Like, isn't that the goal? The goal of this entire market is to make money. So if you want to invest to make an impact, best believe the 10 shares that you bought of Microsoft are not doing that. You bought those 10 shares to make money. Let's be real. You didn't buy 10 shares in Microsoft to give them capital so that then they can go ahead and invest it the right way so that we can have internet for all. And no, if you want philanthropy, go be a philanthropist. Go figure out a way to give back to your community. Right? And that's why so many people of a high caliber earnings, they find ways to be philanthropists to give back. Because they want to, maybe they feel guilty about earning so many millions in the market without doing a single thing and just taking it from others, essentially. Right? Or they just want the tax benefits, maybe. And they don't really care. Or they want to put money here to change the perception of them somewhere else so that then they can be able to be passed on something on the back burner that they're actually building that may be detrimental. But guess what? It's net. You get me? Like, right. Amazon's earnings calls tomorrow, right? So let's talk about, let's not talk about what has happened. Let's take a look at what is currently happening, right? Amazon's earnings call is tomorrow. Cool. Q4 earnings tomorrow. Expected to see 211 billion. Earnings per share at about $2. And they're saying AWS needs at least a 23 growth to boost the Amazon stock. Right? What have we seen Amazon done as of late? I've seen a lot of news come out talking about how they've done a lot of adjustments to their robots to be more efficient with the delivery system. I believe they recently cut off UPS from their delivery mechanism and infrastructure. I see that they've also laid off a ton of people. I think like just recently, they like the head count of like robots to head like actual human workers like is starting to like kind of shift where they're getting more robots now and cutting people off. Like, you see what I'm saying? So now what does that mean? Amazon spent tons of money already in R&D for robots. You don't have to pay robots a paycheck every 2 weeks. You buy it once and done. You fix parts every now and again, and they don't get tired. What does that mean? Potential margin expansion. Is that going to happen right now? We don't know. But maybe the perception of that margin expansion will be on display with earnings. Maybe the CEO of Amazon and the CTO and some other individuals come out and they say, hey, look, we've been able to build out this, and we've been able to save on our expenses by lowering headcount. And also our AWS has continually grown, and we actually plan on doing X, Y, Z and ABC. Guess what? The perception may shift, right? But don't let them say the one wrong thing and something of that detriment that people are going to drill in on and focus on that thing. And maybe their earnings ends up good even without that. And they may drill in on that. I don't know if Amazon is going to have a positive reaction. There's never a way to know a positive reaction to earnings. You can gamble on it and be right. You can gamble on it and be wrong the same way. You know what I mean? I just think any and everybody should use those forms of capital allocation very sparingly. Very sparingly. Like, okay, I have a hunch. Okay, I'm up on the year 15% or whatever that is. I have some cushion on my upside. Maybe I could take a little sliver and I could put $200 on a call option that may expire next week. That's fine, in my opinion, in the risk profile, right? Some people have different tolerances and can't stand to see negative 70% if they're wrong. That's fine. Someone like myself may have some tolerance to say, sure, I'll put $500 on it. I'm willing to lose $500 entirely. I'm willing for this contract to go exactly to zero on the probability that I think Amazon may come out with good earnings and good commentary about their business and the growth prospect of their business, and the perception of that news and the information will corroborate that the comments around their business, good earnings, good revenues, and because of that, the stock price will probably increase. You know what I mean? Like, I'm willing to do that in a way, like if I'm comfortable in doing that, right? Like, am I always comfortable in doing that? No, sometimes I'm down like fuck. And I'm like, damn, I'm getting beat up right now in the markets. They killing me, bro. And I can't, and I'm not willing to put that $500 bet on earnings because there's no edge in that to me, right? So you have to know when to draw. You have to know when to be gluttonous in the way of having tons of positions and things are going your way, and you're up. Maybe you got 8, 10, 15, 20 positions open, and damn near all of them green. You good. You know what I mean? And and because of that, you also need to understand when to become more lean, how to use data points to become more lean. One data point that I use very, very often, and it's going to be a little bit complex, in that same vein of discussion, can you talk about going on tilt and after a hot streak? Sure, I got you. You know what I mean? Like, you could be hot, right? And it's important for you to reel it in and become more lean at moments, right? Which is why I've instilled two major things in my trading over the past 2 years, roughly, that has changed it entirely for me, because I found out a bit more about myself, how I react to those things, how I react to the emotions, and also the decisions that I make based off those emotions, and then how I go about managing them in the meantime. Because ultimately, I mean, you can rewire yourself emotionally, right? But that's a longer, drawn out process, right? That's a 5-year scenario, right? Like, I'm at the point now where I may put a position on, and I put it on the Thursday night, and then the Friday morning, I'm down 80%. And to be quite frankly with you, it sucks, but I kind of don't care. Because one, I've built a system around reducing my risk and managing my risk so much that a lot of times I'm already confident that I can make that money back. And then two, maybe I didn't even lose any money in the first place, right? So an example of that was, what did I sell for? Bloom. If you look at Bloom, I took this trade from the break of like 95, 100 roughly, and I've been in it just coasting. And this entire time up, I've just been trimming. I had 5 contracts maybe at this point at 100, trimmed one here up 17%, trimmed another one here up 30%, trimmed another 2 here at 45. Oh, okay, cool. You got a nice pullback? Cool. Nice. It bounced well. Oh, wait, maybe I want to add 2 more. I add 2 more down here in the pullback. Oh, guess what? I'm going a nice big push up. Oh, great push up. Trim more, sell more. And then to the point where a day like today of down 12, almost, I think it was at 16 plus at one point, it doesn't matter to me. I've already made so much in this entire move that the pullback here to me looks more like a buying opportunity as opposed a buying opportunity to catch the next continual leg up as opposed to a panic, oh shit, I'm down because I didn't sell anything on the way up. I've already put that back to cash. I started at 5 contracts maybe, trimmed all the way down to 2, added 2 more here, came up, trimmed another 2 in that big push up. And now I'm sitting on 2 contracts. I've already locked in on 10K in profit. I'm down 2 or 3K on this 16% move. I don't care that I'm down on that day as much. Why? I've already locked in profit on this position. So I'm already in profit on that way. And I built that out, that trimming cycle, right? The trimming cycle, as well as adding duration to the purchase of what assets that you buy. Those 2 major shifts made me profitable. In like when I say made me profitable, it took me from break-even years to maybe 2 or 3%, slightly performing the S&P, kind of being like, damn, I should just buy the index and shut up, to performing at 99% years, or I think it was 93% I performed in 2024. Last year I performed at 53% on my income, like on my trades, right? So like that's what that leads to, because I understand that some of these markets go up and they go down, right? So me locking in the profits creates that mental clarity for me while things are going up, that when we see a crazy day and stuff just falls from the sky, why is it not scrolling? Okay. And stuff falls from the sky like silver did on Friday while I'm sitting at my gate waiting to board for a flight, and I can't really do anything because I'm about to board and the internet's trash, and it doesn't matter to me. I've trimmed. I've positioned myself. I've cut. I've locked in profits, right? You got to know when you are being gluttonous and want more. And you have to differentiate between being risk averse and protecting your capital, covering your head. So you can go on a hot streak for some time, and you also have to be okay with selling your losers. Sell them, because guess what? You can always buy it back when the cash settles. Or if you're on a margin account, you don't have to wait for the cash to settle. You can buy it back 2 hours later. Don't advise you to do that, really, because things didn't really shift in that sentiment, right? But you can go on a hot streak, and that's great. But make sure you lock in enough profits on that hot streak to sustain the downfall that is imminent. It's going to come. It's about when it's happening. It's about when it's happening. And guess what? I also shared this with my community earlier too. I've made way more money trimming and locking in profits on the way up and just waiting for a pullback, waiting for some calmness in the market to find me a better re-entry or better use of my capital to be back in a position than I have lost or missed out of an opportunity cost by holding something from 100 and trying to wait for it to get to 200. And being so stubborn in the fact of, I'm not selling until we hit my price target and rah, rah. Trim into strength and re-entering on pullbacks is making me money as well. Exactly. Trim into the strength, especially for trading options. Why? Because the volatility on the strength, you may never see those to the point where sometimes it ends up risk-free. Exactly. You buy 2K into a position, right? That 2K goes up 50%. You've now made $1,000 in profit. guess what? You can trim. Nobody said exit the position. And I get it. Some people with some smaller accounts, it may require you to fully exit the position. Guess what? That's fine. Fully exit the position. Because ultimately, you need to build your capital base in the same vein, right? Like the same way you need to build your portfolio from a 10K portfolio to maybe 100K. How are you going to do that by continually having unrealized gains? Crickets. Exactly. You need to lock in the profits. Just make sure you're being smart with the profits and re-entering with those profits. Be okay with exiting. Yeah, exactly that. You can eat one way. So now if you're able to marry the data, right? The regime shifts. The fact that Oracle signed a crazy deal with OpenAI, the company re-rated from 420 billion to basically almost $1 trillion in 4 months because AI was the greatest thing in the world. The perception shifted, and then guess what? The perception shifted the exact opposite way when it became reality because OpenAI continually has profitability issues at the moment, and they continually ask for more and more and more and more capital when it doesn't really quite seem to be a position where they're finding their way into profitability. Perception turns into reality. And sometimes it's about those two cases. If perception continues to actually shift into reality, we would have seen Oracle probably at 300 or 400 right now. But that's not the case. The opposing factor occurred. The perception of OpenAI's dominance and growth and profitability shifted, to now what is a negative and weighing down cancerous effect on a company like Oracle, who took out a lot of debt to try and fund this scenario and push the company forward and used a lot of their operating cash flow to be able to push the price lower, because that perception that we had originally does not seem to be panning out into reality. And if you stood here and took this trade and was stubborn enough to say, no, I'm going to sell at 400, guess what? You fully retraced. If not, probably your contract's already expired, worthless. When you could have put a 2K position on, trimmed in maybe a 3-step process, took your 2K to maybe 5K on a reasonably priced option with some good duration, right? Sold it, and then being able to realize, like, oh, wait, why is it no longer going up? Okay, I bought the dip, but wait, it's still dipping? Wait, I'm putting my risk here. I'm done with risk. It's no longer following my rules. It's no longer an asset that I want to hold. I will sell it completely. You have to be, I will sell it completely and buy it back tomorrow. And that's exactly what I did with Caterpillar. That was actually exactly what I did with Caterpillar recently. Caterpillar did super, was like basing right around here at a previous price target, right? Like I took, let's see. So here's the setup on Caterpillar. And that's also why I talked about Caterpillar so often in this stream, because that's one of the names that has like continuously come back to me. And I'm like, oh, wow, that's crazy, right? So I took Caterpillar here on this breakout. I said 600 is probably coming soon. Broke out, used my managed risk hairline. I got out on this day. And I ended up buying it back the very next day. And what did it do? It continually printed for me. It gave me another 6-7% higher. Came back down. What happened? It came back down after the balloon, or I'm not going to call it a balloon because that is in similar reference to bubble. I'm not going to use those same words. But after the trend After the wave came in and then it receded a little bit. When the tide comes out, don't get caught with your pants down. Understand when to be gluttonous, when to add to positions, when to be when to put risk on the table where it makes sense to taking risk, and know when to delever and cool down. It's okay to have one contract, because that one contract can do numbers. You don't have to go balls deep and throw 10 on the table and yeah, right? Because it's going to force you to sell way quicker than you want to. Remain patient enough to be in the game long enough that you don't burn all your damn capital on one trade. Because guess what? It will retrace, and it can. And then guess what? It'll go right back to where you were before. And then guess what? It'll continue to find its way higher after that as well. The same way, vice versa, how these names can go all the way to the moon and then find its way back down. Look at Palantir. Look at Palantir. Without duration, you can't stay around for the cover. Yeah, because you're going to burn all your capital in the meantime. Palantir, oh, it's trading at 5,000 price to equity ratio. It has to go down. Oh my God, it's overvalued. Okay, sure, maybe it is. But the perception is Palantir is the greatest thing. So until that perception can shift into the reality, you won't see a re-rating of price. And now what? We're down 33% from the highs, because the perception seems to be that, you know, maybe Palantir ain't that, you know, like as of right now at least. Look at Hood. Look at Robinhood. $150 stock 2-3 months ago. It's down 45% from the highs, because the perception of Robinhood's taking over the market. Oh my God, everybody's going to use it. Look at it. Post-COVID, wow, they even into retirement accounts. Oh my goodness. Madness growth into, okay, you know, maybe it's not that popping. It's not really doing too, like, it'd be its earnings, but like, is it really worth that? I don't think so. Like, you see what I'm trying to say? Like, I hope you guys get what I'm trying to say. I'm trying to beat home on. Even the greatest companies of all time will have these moments of evaluation re-rating. And in the moment of you being able to trim, manage your positions, go from being fat and fully risk on and having a ton of money in these high concentrated bets, and knowing when to trim, cut, get out of there, and move on with your money. Right? And you can do that by paying attention to the entirety of the market, by creating a watch list of assets. Oh, the Mag 7, what they're doing. Oh yeah, they're 40% of the QQQ, and they're 50% of the QQQ, and they're like 35% of S&P. Okay, that's cool. And then you see things like the equal weighted index, which take away that superpower of 33% in just 10 names. And they give every single name in the 500 the same rating of price, and you see it up 1%. And on the year, it's up 4%. Meanwhile, SPY is basically flat on the year. I wonder why. Oh, maybe because the names that have the most weighting aren't doing well this year, so far at least. Right? And you can find that. Then you look around and you say, oh, snap. These deep value names like Costco, like railroads, like Unilever, cyclicals, companies that grow when the overall economics of a country are doing relatively well. They're having the shine. And then you can figure out where to rotate. Maybe I shouldn't be in big tech right now. I need to have some Walmart calls or some Verizon calls or some UPS, right? And you can see those shifts also by watching options flow, watching index flow, Watching data, seeing what makes sense, right? USO, doing well. XRT, retail. What did we talk about earlier today? Retail is actually doing relatively well, right? We're seeing names like Dow, and they don't mean the Dow index, they mean the chemicals producing company, having huge sweeps. Why? Because the industrial complex is getting bigger. Oh, we're getting companies like Exxon doing 3.16 in premiums with huge leaps into next year, December. Why? Oh, maybe because energy's doing pretty darn good, right? We take it XLE, look at that. The energy ETF tells us all right here. It tells us what is going on. So don't fight the tape. Just know when to shift. Know when to be risk on, know when to pull back, understand what's happening, right? Try to catch these trends at the pendulum adjustment when they flip back and forth. Don't be afraid to sell because you can buy it back. You can buy it back. And not only that, this whole move into 24/7 tokenization stuff, you can either buy it back at 9:47 p.m. in probably the year or two. Two. Instead of looking at this static price on XLE at 52.83. So, um, you know, I don't know what else to say, but maybe get out of your bubble if you're in a bubble, right? Oh, I only trade these 10 stocks. No, look at the entire market. Read more than you've ever read before. Put together things, dive deep into it, think thoughtfully, think fully and whole. And maybe you'll be able to find some cool things that are undervalued and you can be an owner of them for quite a long time and be able to be a part of the upside re-rating or the valuation. Maybe, maybe not. I don't know. You know? Um, but yeah, you got names like Palantir falling through the base. Is it a base anymore? Shoot, probably not. I could probably erase all this, right? Remove all the drawings and just wait to hear something else. You know? And when we look at oil, no, I didn't talk about Brazil. We could talk about Brazil. It's also why I created a watch list of the world. So I could try and see what's happening globally and put that within my thesis. I guess I can rein in about Brazil. I think that's EYZ. Yeah, EYZ. Or EWZ, sorry. So Brazil is in a really particular state right now. Um, they have this like democratic socialism leader that's made some policy shifts to be a little bit more capital pro capital, you know. Um, and when you're pro capital, guess what? Your capital markets increase. Like perception shift into reality. Oh, this leader's gonna provide X, Y, Z, A, B, C. Are they gonna actually do that thing, said thing? Maybe, maybe not. But maybe in the perception rally of that person going to do such, it occurs. And in the reality, it deflates, right? Let's look at Bitcoin real quick, actually. One sec. Right? Perception was, oh my God, Trump's gonna win. Trump's gonna win. Yeah, he's gonna be pro crypto. Yeah, yeah, pro crypto. Trump's gonna win. He gets into office, and then 6 months later, after signing the Transparency Act, I think it was, or whatever, and then the Big Beautiful Bill, whatever, right? Nothing else happens. for Bitcoin, really, for the administration, at least, right? Like, what has he done other than say that he's going to create a strategic reserve, and rah, rah. Like, nothing's happened. So what happens? The air comes out of the balloon when you let go of the nozzle. So Bitcoin is kind of taking a tumble here. There's other things included in this. That's a very broad, not painting the full picture of why Bitcoin is down to 71K right now as opposed to 100 or 125. But if we were to look at it, they elected Trump in office because, oh my God, he's going to be pro-business and pro-crypto and pro. But all he's really been focused on is tariffs and the globalist perspective, right? So the Brazilian team or the Brazilian leadership has done similar actions where we can see that. Right? So once you see the flow's going to happen before the news really hits. Like roughly before the news hits. Sometimes it happens in tandem, but sometimes the flow like really just. So I dropped this integral research at the end of January. The Brazilian stocks recorded a 2.3 billion in foreign inflows so far in January, the most single month increase since December 2023. This is more than double than the prior 7 months combined. As a result, the Brazilian stock index rallied in 9.7% in the dollar terms last week, at the best performance in the world among major equity markets. Buying has to happen for the asset to increase. So once you see these adjustments in tons of buying, it can be oh snap, look here. Oh snap, what's happening here? Like, and it can go into that now. So now that's where we start. And then we go and look and see, okay, EWZ is just the index of the Brazilian market. So now let's see what's actually in the Brazilian index. Like, why is it receiving so much inflows and reporting a 20% increase year to date? Okay, you see. Cool. We got new holdings, financials. That seems to be the biggest weighting. So NU is the ticker there. This materials company. What did we just talk about? Materials. We just talked about how materials are doing very, very well, right? Because policies put in place, things of that, right? Things of that nature. Okay. I don't even know this company, but a financial company. We talked about the leader being more capital positive, and you're telling me, right? Then we got Petro Brazil and another petrol company, and then another company, and then an industrial name. So if you're okay, so let's zoom out. You're telling me 11 plus 11 plus 8 plus 5 plus 5 plus 3 plus 3 plus 3 plus 2 plus 2. You're telling me these top 10 names right here are 53% of the ETF EWZ, and these are all sectors that are doing really well, and the economy is doing really well, while their leader is pro markets, meaning financial names are on the upside, right? All while materials and energies are having breakout years. Of course, this thing's up 20%. Like, I don't even have to get into understanding what Itu Unibanco Holding does exactly per se. I would like to, I will, right? But Stanley Druckenmiller, one of the greatest investors of our time, somebody who I really like research and try to gain deep insights and thoughts from. Learned this thing from his predecessor, George Soros. That sometimes you invest first and investigate later, right? Sometimes you just have a hunch about something. You can do a quick search on XYZ ABC, and then you can start to connect those dots, and you say, okay, cool. Maybe I'm not going to put on my full position size in this EWZ, but I could do a starter position. I could maybe put, whatever your starter position is as you individually, right? Maybe my starter positions now are like 2 to 3K roughly. And then I tend to lean into it more over time as I continue to do more research and flesh it out and more confirming things come out. I kind of lean into it a bit more, and like I'm okay with doing that. And then maybe I end up with a 5K to 10K exposure in this name, and I just end up writing it out because I have enough duration to be able to go through it and do all these to do all the holdings, right? But when you look at it from that point of view of what we just talked about, when you look at these indexes and what they're performing at, like you're trying to tell me that basically the top 5 sectors right now in the year, I could tell you off the top of my head, just by watching the markets on a day-to-day, looking through my watch lists to see the different sectors. How are these sectors performing? What's happening here? What news is connecting to these sectors? Energy, probably the biggest sector this year. Why? AI. Oil is a thing, a major thing, especially for this administration. Materials and industrials having a huge scenario. Critical rare earths are a huge thing that's important. We basically went to a war with China over rare earths 6 months ago. What makes you think it's not important 6 months from now? Like, what materially changed from having this long drawn out trade war with tariffs on, tariffs off with China to now it not being important all of a sudden? That would require the Trump administration and other people to not care about them. That would require AI to no longer be that important. That would require all these other things to not be important anymore. From the perception shift of these items are important and necessary for us to grow in AI, and this is what's pushing our GDP to, yeah, AI is just a fad, like whatever, which is the reality side of it. Maybe it is, I don't know. But I'm trying to connect the whole talk that we're talking about of perception shifting into reality, whether that ends up being a tailwind for the original perception, and it ends up just drifting the asset class up and to the right, or the reality comes in like a potential headwind and it forces back the asset lower to a re-rating, to a decrease in value over time. So when I look at Brazil and I look at the top 10 holdings being in the main top sectors of the performance for the year, it makes sense why it's up 20% in the year. It just makes sense. The entire ETF, 38% of the ETF is financials, 14 in materials, 12 in energy, 12 in utilities as well, another 9 in industrials, and another 5 in consumer staples. This right here is the cyclicality of what the current environment that we're in. So most of this entire index is going to be up and to the right simply because of that, on top of their leadership. So like, we can get into it. We can go into the fact sheet. We can look at all these numbers and ratios and net asset value, rah, rah, rah. But sometimes you can also just zoom out and be like, well, this is what's going on. They're passing laws about this. These sectors are important, right? So I'd implore you, if you're using TradingView, to please create multiple watch lists so you can kind of view things from a sector point of view. This world watch list gives me a point of view of like what's happening in the world right now. Also, we talk about South Korea too. Why is South Korea up and to the right from 50 change down here into 120? Because they're like their main thing, Samsung booming, SK Hynix booming. Exactly. Why? Because AI is important. Why? Because they need flash memory. We need NAND storage. We need those things. The same reason why, like it is what it is. Like it just is what it is. Whether that perception will turn into reality because these companies are buying these NAND storages and such and so forth. Right? We'll see. And then maybe over time, these companies will expand their inventories and be able to meet all the demand of flash storage. But as of right now, it's not. And people are willing to pay well above the market price of what it was just a few months prior. Oh, I'm not showing my screen. 1 sec. Look at this. Look at the price of DRAM and NAND over time. Up and to the right. Looks just like South Korea to me. And when that makes up, now, okay, let's connect the dots. Let's do it. Let's do it. Boom, boom, boom. Boom, boom. Bro, what else I have to say? Samsung weighs 27% of the index. SK Hynix weighs 20% of the index. That's almost half of the entire country's ETF in just those two names. After we see the price of the assets that company sells go up 4-fold, 20-fold in a short period of time, that literally created a re-rating. Sorry, not 20, not 4-fold, but from 2 to 16. It only makes sense for that to occur. Like, come on. We have to start thinking from first principles and remain thinking in first principles through every single day in the market. If the asset that the main two companies of the entire ETF is going up and to the right in the price of those assets because there's a shortage in those items, obviously the underlying index will do the same thing, will do such. Right? They'll do the same thing. So I use these watch lists to give me a point of view of like, where is the money flowing into? Okay, the world view, cool. South Korea, Japan, got it. Okay, Mexico. Mexico is doing really well as well. Why? Because they're very industrial based. Let's go do industrial. Let's go do one more before we look at another watch list potentially. Mexico's ETF is EWW. I wonder what they're doing. Something tells me, it's not showing, okay, my fault. Something tells me Mexico, oh wow, materials, financials, consumer staples, Walmart, the company that just hit $1 trillion in market cap. I'm sure it's doing pretty well in Mexico as well. Materials companies, CEMEX. Oh, I love that company. That's been one of my favorites as of recent. Cool. Industrials. Excuse me. Right? If we go look at it, these are the sectors that are doing well. We just talked about the sectors that are doing well. The sector rotation can be your best friend. Stop fighting it. Stop marrying big tech and only big tech. Listen, there's multiple millions of ways to make money in the market. Being pigeonholed into one way that worked just because it worked last year, just because it worked 2021, does not mean it will work February 5th, 2026. So be open to learn what is actually moving the needle, where are policies actually shifting, where are prices of the assets that they are selling actually shifting, what policy things are occurring that are actually creating new value. The reason why I'm a big fan of CEMEX, right, is because of the industrial complex. You got Trump on one side, just north of Mexico, talking about how they're going to, they're pushing this industry stuff. We need to get back our blue collar workers and rah this and this, that, and the other, right? And you also got them expanding deeper into other markets, acquiring other markets, right? From other companies that may have dominated that market as well. And then you also have markets. Maybe it's not there. You have other markets also doing really well too. So boom, this is my integral holdings on why I like ILF, which is Latin America. The Brazilian rate cuts. Why? Because the leadership said, hey, they're going to do some rate cuts. Triggers re-rating in banking. Oh, guess what? Most of their indexes financials. Wow. Commodity price discovery, copper, oil, all these companies live in those spaces. And in most cases, they only have ADRs in the public markets in the US. Argentina has a turnaround story where Milei, their leadership, their inflation's been way out of hand for several years now, but he's kind of moving like Trump now and opening up the markets and trying to figure out a way to calm inflation. Some M&A activity is also happening. There's moves in Brazil and Mexican banking sector, things of those natures, re-rating, all on top of the fact that guess what? The US dollar is continuously getting weak, meaning that emerging market currencies are actually increasing, and it ends up being a tailwind for those assets to marginally just rise and up and to the right. Anyways, back to this. Where is it? There it is. Mexican cement, CEMEX, 2026 EBITDA potentially reading 3.4 billion, up 10% on the year. Right? We raised. Bank of America came out saying they're raising their, the price. Like, okay, it looks cool. Why? Because they're incorporating higher cement and ready mix 2026% pricing, right? In line with inflation. So they're going to raise prices. Seeing single-digit growth in Europe at the back of the EU carbon border adjustment. What's that? Let me go Google it. Oh, it's basically Europe saying that they're going to be green and economic and not produce cement and basically offshore it to CEMEX in a way so that their air is green in Europe and not right. Exactly. Those types of things too, right? If you're not looking at the chat right now, Cody just mentioned, CEMEX is looking to potentially create a huge win. Why? Because just recently they bought Caribs Cement, which is the largest cement producer pretty much in the West Indies. And the hurricane basically came through and destroyed tons of infrastructure. What do we need to rebuild infrastructure? Cement. And it's not just Jamaica that the hurricane hit too. Guess what? It hit most of the Caribbean. Like let's just be real for a moment. Like 1 + 1 = 2, bro. Stop making it hard. You got Europe making these policy changes where they're trying to be green or They're trying to be visually green to society by offshoring their industrial efforts to Mexico and to other countries, and then importing it instead. FX forecasts, right? Because these emerging market names, foreign exchange, guess what? The dollar is down 4 to 5% depreciation. That's going to be an easy tailwind for these international assets to continuously, bro. That's what I'm saying, bro. But that doesn't matter. It's all perception. Oh, look, it goes right back. Oh my goodness. I think this is a realization as well. Like, I've been harping about this. I don't give me a word count. How many times have I said perception into reality in this stream? The perception of Europe being green until they realize the earth is still warming. And it's not the reality. Like, you know what I mean? Like, bro, let's just be real. They're going through aggressive cost-cutting measures, finding ways to create savings, all while being able to expand on that into new markets. So I'm a big fan of CMEX. I'm long. I'm talking my book here, but whatever. I'm speaking with my truth and my research. And yeah, it was down today. Guess what? I'm looking to figure out a way to buy more. I trimmed some of my shorter duration. I'm trying to figure out how to buy some longer duration so I can sit through it. Latin American rate strategy, which I just talked about as to the main reason why I like ILF, which is the Latin American index, and Brazilian, Argentina, and Mexico, and sorry, not Mexico, but like all the countries in the Latin American index, ILF, right? Like, just be aware of what's happening in the markets. And like beyond just general situational awareness, take time to read through things. I mean, shoot, we got Chat GPT now. You can just ask it. You got Claude, you got Gemini, you got all these models. Ask it what the hell it means. Copy and paste it. What does this mean? How does this potentially affect the price of the company? What kind of effects could be in negate or negate this case? What risks are we maybe not taking into account here? I don't know. Take a look at the data, see what it says. And then if we go back to some of the older data that I shared, let me try and see something that maybe I shared in December as a data point, and how that potentially helped out. I don't know. Maybe I don't even have to go back that far. These are just some of the data points that I'm continuously sharing, and more of my thoughts as well in the market updates. So I mean, hey, if you want to join Integral Pulse, Integral Volt, the link is in the description. Go ahead and join, and you'll see where I talk about things, my point of view on them, how it may affect price on assets. I also talk a lot about more technical things like volatility in some cases, than trying to figure out pockets of air where the market could retreat and where we should maybe be reducing some risk on our upside and maybe hedging our bets a bit heavier, like getting a bit more lean as opposed to being gluttonous and trying to sit through these longs. And I'm kind of just trying to make sense of it all and connect the dots, so feel free to do such and join the sector. I mean, a lot of times I'm wrong and a lot of times I'm right. I mean, it's just a matter of managing your risk in the meantime to try to see what the heck makes sense, generally speaking. Sometimes you get caught up in a super cool thesis like metals and gold and silver, and you can ride the wave from $2,700 an ounce on gold to 5,000, or 40 or $32 an ounce on silver into 120. And sometimes you just get blessed that way. And glory to God, really. Other times you get caught up trying to buy. Sometimes you get like even myself, like sometimes you get caught up being so pissed off that I had SanDisk at $200. Wait, I'm not seeing it. My fault. And other times you get so pissed off that you had SanDisk at $200 and you sold when it broke out to $350, thinking, "Yo, I'm good," and you end up trimming so much and don't replace your exposure with more duration, and you end up missing out the entire move from 300 to 650. That when you get a little pullback on something, you go long, you take some profits on the upside, maybe you locked in 10%, cool. But then a day like today comes through at 15% and it wipes it all away, and you end up down on that position. And you're like, damn, if I was maybe a bit more patient. And yeah, I burned like 2-3 grand on trying to go long SanDisk from 550. Then being up 25%, 30%, and then being down ultimately today to the point where I just closed the position out and I'm like, you know what? I'll just wait for a much better entry potentially. And I'm okay with that. I'm okay with breaking a law. I don't know anything in this market for real. All I know is that the price is going up. And there's a higher probability than there is a lower probability of potentially X occurring. And I'm willing to position myself and dance around it enough to maybe make some money in the meantime. That's it. That's quite literally it. So it's also 10 o'clock. I'm in the markets every day, but I do have a 95. So peace, y'all. Till next time. We'll talk. If you have any questions, obviously, if you're a part of the community, feel free to join. If you're not a part of the community, I'll give you guys a link right now. Is whop.com, WHOP/integralvote/insight. Feel free to join. Again, the link is also in the description. I don't charge buku prices. I really just be in the chat, just chatting, sharing my thoughts, seeing what makes sense. Yeah. And yes, there is a initial fee that is basically a startup fee of just joining. And then each month it's like, I think $14, I think, a month. Yeah. Or wait, is it $14? My fault. I think I did a price hike on the year, so it's probably closer to $16. I don't remember. But some people are in at the $14 price. Age of 14, how to do what I got to do. You know what I mean? You know what I mean? Is that the link? Oh my gosh, this thing can kind of get a little confusing. Just a little bit. Oh, sorry. It's $19.99 now, guys. My fault. There's the link. I'll edit the stream notes at the bottom too, but bless. Appreciate it. Yeah. And effectively, you guys just helping pay for some of the data that I bring in. So you end up getting all the value back with all the data that I'm also showing, because data is expensive. Trying to be in the markets and like that's really where the edge is. The edge is in the data and like being early enough to be able to grab the win in the market. So yeah, but that's pretty much it for me, y'all. I'll catch you all the next one. I'll probably do it again Sunday. This was the catch-up one from the one I owed you on previous Sunday due to some traveling I was doing that I missed out on that stream. I just figured the timing kind of made the most sense to just give it up to you guys now. So I'll catch you all in the next one. Peace. Agent out.